Hey everybody, welcome back to H Invests. You've probably clicked on this video because you've watched my previous video on sustained high inflation levels in the economies, and particularly the US economy. And I didn't want to leave you guys on a cliffhanger, as you know, to be thinking, right, like how is H setting up his portfolio to deal with this high inflation going forwards? If you haven't watched that video on that inflation, then please do. I think you'll find it very, very useful. But in this video, I'm just gonna very quickly show you guys roughly how I'm making changes to my portfolio, or, well, most of these changes I already made about 6 to 8 months ago, but I'm gonna show you what they consist of. It's gonna be a very quick video. I'm not gonna show you any kinds of graphs or anything, but I will expand on these concepts in future videos, particularly highly requested concepts. So I'm just gonna give you a very brief overview now, because I thought it was necessary that I got this information out straight after I got the inflation video out. But yeah, as I said, if you guys want, you know, expansive detail on any of these concepts, please let me know. I will be publishing videos on them going forward. Right, so here we go. Number one, I've reduced exposure to the US market. Part of that is that the risk of me being in dollars as a UK citizen who spends my money in pounds going forward is a bigger risk if the US dollar declines against the pound, which it probably will because inflation is so rampant in the US relative to the UK. Also because the US market is so incredibly expensive, I'm finding much better value exposure in other markets. The UK is actually a very cheap stock market as far as developed stock markets go. We do not have the same culture of everybody into investing as is in America. I know Americans sometimes find that really hard to believe, but not nearly as many people are actively engaged in the stock market as people are in the Americas, and even a lot of people that are British and are from other parts of the world invest in the US stock market, right? I think it has about half of the equity capital in the entire world, right? Which is insane considering the US is only 4% of the world's population. So I'm increasing my exposure to other markets, UK, China, other emerging markets. I'm very bullish on Indonesia, Malaysia, those kind of countries, India. I've got massive long-term put options. Most of them expire in 2023 on the speculative, cyclical side of the US market, you know, where share prices have doubled and tripled in pre-pandemic with a lot of speculative retail money going into it. I've got a video about that on my channel. Link is in the description. These are the kind of companies that will be hurt, you know, when rates go up the most. Their valuations will just absolutely plummet, but their valuations are ridiculous anyway, even when real rates are at -5, -6%. So that's one of the things that I'm doing. I've got much more exposure to non-cyclical, inflation-protected industries that are cheap and paying good dividends. Yes, tobacco is coming at the top of that because tobacco have got a wide economic moat, ridiculously high dividends, relatively no downside because they can just increase their prices along with inflation. That's the way that tobacco companies have been making more money anyway, just increasing their prices incrementally to offset slow consumption demand in cigarettes. Pharmaceuticals are good, they've got pricing power, people always need drugs in recessions. And they're relatively undervalued, you know, they really, really are if you compare it to some of this US speculative stuff. I'm short bonds. I've done the crazy Michael Burry trade where I'm long the TBT and short the TLT. In fact, I've actually got even crazier than that because I've got a leverage position on it because I've had to get a derivative contract on these ETFs because as a British investor, the EU, even though we've left the EU, I'm not going to go into that now, but basically because of the laws in the UK, I can't actually invest in US ETFs, so I have to leverage my position on these ETFs by buying options on them. Again, these options have got 2023, 2024 expiry, but that basically means that I make money when yields go up and bond prices go down, and I lose money if bond prices go up and yields go down. And how much lower can yields get, right, in this environment? They're on the up, particularly with now rate hikes starting to be priced into the market, so that position has worked out very well for me. I've got some cash on the sidelines for liquidity purposes, and that's if this debt bubble pops quickly. I haven't got a ridiculous amount of cash on the sidelines because obviously, you know, the opportunity cost of holding cash is getting higher as inflation gets higher and higher. So that's one thing that I want to make sure is that if this goes on for a long time, that cash that's sitting there waiting to buy assets once they've crashed it is not going to have the same purchasing power because the cash return is negative because inflation's high. So I've got some cash, not a lot. I haven't got many US dollars. I've got exposure to currencies with less inflationary risk. I've got large exposure to gold and other precious metals because they are great inflation hedges and they retain their purchasing power against currency, which can just be printed. Gold can't be printed, so I've got a lot of that. I've also bought a rental property at a fixed rate of 1.64% for 5 years. So I'm technically long a load of collateralized debt, collateralized by the property, which is really, really good. The property might go down in value if we see a big asset pop. Part of the reason that I did this property was to actually get used to buying property and learning about the process. So if we do see a big asset price crash, I can actually go in there with confidence and buy another property off a motivated seller to say, hey, I've done this before, I know how the legal side of this works, I know how mortgages work, I know how completion works, etc., etc. But also locking in that low interest rate for 5 years means that, you know, if we do see an inflationary crisis, which doesn't hurt the property market as much, property prices will skyrocket and that value of that debt will get eroded away. But I've made sure that I'm very well covered, you know, with a decent equity in that property as well. There's 25% equity in there. So property prices do decline. The probability of having that buy-to-let repossessed is incredibly low. And also the cap rate on the property is about twice the UK national average. So I've got a very, very good margin of safety on there with regards to the tenant that's in there. So it's making me very, very decent income. Right, so that is a very much long story short of how I'm positioned financially at the moment. Oh, I do have small exposure to Bitcoin, similar to my reasons for being exposed to gold, but not as much because I think there's much more of a speculative element in the terms of like there's a much higher percentage of speculators to long-term holders in Bitcoin compared to gold, which is why I think we've seen a big correction in cryptocurrency. I do think that it has some of the properties of gold as it kind of being this inflation hedge, but it seems to be much more correlated with what the general stock market is doing, particularly the speculative stocks, than gold is. So I think gold's going to be a better inflationary hedge, and also gold has the 5,000 year test of being an inflationary hedge to it. So that is how I am positioned going forward. Any questions? Shoot me in the comments. I'm off on holiday. I'll be back in a couple of weeks. Hope you guys enjoyed the video and I'll see you next time.